As entrepreneurs and small business owners, we were pretty happy with the 2017 Tax Act in Trump's first term. We got a 20% small business deduction. We got a 21% corporate tax rate. We got reduced tax rates across the board, and we got bonus depreciation. During the Biden years, we got threats of massive tax increases. President Biden was very much on a mission to build up big businesses so that he could build up unions and destroy small businesses. And I say this unapologetically. That was absolutely his goal. Now we have a Trump second term. Today, we're going to discover how good will the new tax law be, because we're getting a new tax law. The 2017 Tax Act, enacted in Trump's first term, ironically, terminates this year as he begins his second term. A very unusual situation, and yet we know it's going to happen. One thing is for sure, your taxes are going to change this year. So what do you need to do to prepare for these massive changes? Are they going to be massive? Are they going to continue the way they are? Is everybody just going to go along happy as can be? Or do we need to be wary of certain changes that might not be beneficial to us as entrepreneurs? And today, I'm going to tell you not just what I think is likely to happen, but also what could happen, as well as what can you do regardless of what happens. So this is a very important program of the Wealthability Show. You're going to want to listen to this, pass this on to your friends, and particularly your cohorts, other entrepreneurs, so that they can understand, here's what they need to do. We're in January. We can do something for this year. It's too late to do something for 2024 other than get a good tax preparer. But for 2025, we can make big changes. So what do we need to do? What's going to go on? What are we going to expect? Many people believe that, oh, well, we're just going to get all the same good tax benefits we had from 2017. And we may get some new great tax benefits. Here's the challenge. Who's going to pay for it? So either we're going to have massive increases to the deficit, which will stimulate inflation, or we're going to have to pay for what we get. Now, the question is, how are they going to score it? What are they going to do? We're going to do a separate podcast on how they score, how they pay for the different aspects of the tax proposals. But let's talk about what the tax proposals are right now. And let's talk about maybe what some of the changes might be. Let's start with corporate taxes. The corporate tax rate reduction to 21% was the only permanent aspect of the 2017 tax law. So the 21% is not going up. Now, could it go down? Yes. Here's the question. Will it go down only for manufacturers? There is a pretty good indication, and President Trump in his campaign kind of indicated this, that he'd like to see it 15% across the board. If he can't get it 15% across the board, he wants to see it 15% for manufacturing. Okay, well, to get to the 15% for manufacturing, it's probably not a tax rate. What we probably get is we probably get the domestic, what's called the DAPD. We probably get that back, okay? And that was a deduction to reduce manufacturing tax rates prior to 2017. It went away in 2017. So we probably get that back in order to get to 15%. Now, if we go to 15% across the board, I'm going to be telling small business clients, we really ought to consider being a C corporation, not being an S corporation. Because here's the other question. 2017, in order to compensate small business owners, it was really to get it passed, right? the 21% rate that we went from 35% to 21% did not affect a lot of small businesses because most small businesses are pass-through entities like partnerships or S corporations. So the question is, if it's not going to affect small businesses, then how does, are we going to keep small businesses at a high tax rate and lower big business only? So Senator Marco Rubio, now soon to be Secretary of State Marco Rubio, he was on the forefront of saying, no, we need to protect small business. We need to give them a tax benefit. So we got the qualified business income deduction, or QBI deduction. The cost of that is $400 billion over 10 years. That's how they scored that originally. Okay. So let's keep that scoring in mind here. They scored it at $400 billion. That's a potential pay for. In other words, if they don't do that, then they've got $400 billion to do for some of these other things. Because let's look at, not only do we have a potential $4.9 trillion that has to be paid for if we extend. Now, there were pay-fors in the original bill, so it's not really 4.9. Okay, I think that's misleading. And we'll talk to Garrett Watson of the Tax Foundation when he comes on in a few weeks. We'll talk to him about that. But while it's not 4.9 trillion, it's got to be paid for. Okay, and we're adding on top of the original tax benefits from the 2017 Act. Because remember, they scored over 10 years and it's due to expire largely at the end of 2025. Okay, well, if that's true, then all right, we got to pay for extending it, right? Like we did with the Bush tax cuts. Same idea. We have to pay to extend it. Well, the reality is, let's talk about real money, right? Whether they choose to score it or not, is it going to contribute to the deficit? So they're going to look for pay-fors because we do have some deficit hawks in Congress on the Republican side. That said, let's go back and look at this $400 billion. Well, what could it pay for? Well, those on the West and the East Coast, and particularly New York, New Jersey, Massachusetts, and then in the middle, Minnesota, and then on the West Coast, particularly California, they would like the SALT deduction, state and local tax deduction, to be increased. And it looks very likely that it's going to be increased from $10,000 to $20,000. So you can put that in your book. You can get a $20,000 tax deduction, up to $20,000 of tax deduction for state and local taxes. Doesn't affect small business, because we're already getting it with the PTE, or pass-through entity tax deduction, that most of those states offer. So if you're already taking advantage of deducting your state and local taxes, then getting it going from 10 to 20 doesn't help you at all. It only helps high-paid employees, does not help the entrepreneur. Okay, but it's got to be paid for. All right, what's next? Well, we have not the idea of making tips, particularly in the hospitality industry, tax-free. That's a lot of money. It's a lot of money to exempt tips. Does that help small business? Well, if you're a restaurant, it might help you attract more employees, but will it actually help you from a tax standpoint? The answer is no, it does not, right? Because you're not getting deduction for tips anyway, and because your customers are paying it. So it's a wash for you, but it's got to be paid for. What about increasing the limit on what's taxed in Social Security? Right? The idea is to index that somehow, to get it up higher so that you're not paying so much income tax on Social Security where you didn't get a deduction in the first place for the money you put in. Not a bad idea, but somebody's got to pay for it. Okay, President Trump talked about not taxing overtime. I think that's less likely to happen, but that would also be a big one. And there are others. Vice President Vance has talked about a $5,000 child tax credit, and the Democrats really want that tax credit as well. So if that's the case, how are you going to pay for it? And so now what we have to look at is, okay, we have certain tax benefits that we would like as entrepreneurs. And the big one is the qualified business income deduction. Okay, so I think that is up in the air. I do not think that's a slam dunk. Next, bonus depreciation. Bonus depreciation has been huge for the entrepreneur and small business owner. Why is that? Well, because we not only, we were getting 179 deduction anyway. So we're going, well, what's the difference? Well, but a lot of us bought buildings. We own buildings. And we had the incentive to have bonus depreciation. And frankly, most entrepreneurs should buy the building that where their business resides. If you're going to have people in the office, why pay rent? It's a little like a house, right? Why pay rent when you can own a house? Why pay rent when you can own a building? So especially when the tax benefits of real estate are so high, and you don't have the passive loss limitations when you're occupying the building that you own. When it's your business that's occupying it, you don't have the passive loss limitations. So you get all that depreciation. That bonus depreciation is huge for entrepreneurs who are owning their own real estate. All right. So is that going to continue? Remember, that now is scheduled to phase out in the next couple of years, right? It started phasing out in 2023, 2024, 2025, 2026, but in of 2027, it's gone. Now, we've had bonus depreciation for many, many years. It just only applied to new equipment, and in some cases only applied in the case of manufacturing. With the 179 deduction, which I think most people are familiar with, the equipment deduction bonus depreciation doesn't affect us much. What really affects us is the real estate bonus depreciation. Are we going to get it? Well, it's a big pay for. And it's a big cost. So will we get that on real estate, particularly on used real estate, right? I mean, let's face it, there's no real theoretical foundation for giving bonus depreciation on used property. Bonus depreciation makes more sense when you're buying new property. Or will they just change the rules so that if you take bonus depreciation, then when you sell it, the buyer doesn't get to take bonus depreciation again, right? Which is what's been happening because there's no matching, right? Like when you sell your business, there's a match, right? Whatever you are saying you sold is what the buyer is buying. There's a form for that on your tax return the year you sell your business. That form does not apply to real estate. Now, maybe they just make it apply. That could actually, I think, would be a good answer for that. But then you would end up losing bonus depreciation in a lot of cases. You'd have some recapture, or you'd at least have a matching like you do with selling a business. Now, will they do that? I haven't even heard anybody talking about doing that. So I'm not really thinking that's going to happen. Are we going to lose some of the benefits that have been there for a long time, like can exchanges? We're not. Are we going to get back the research and development tax deduction, research and development deduction? And the answer is yes. I would bet some money on that one. We need to get that one back. Remember, that phased out as part of the 2017 law. So the reason it's gone in the first place is because of the 2017 law. But the Trump administration very much wants to encourage manufacturing, and they want to encourage research and development. I believe they're going to bring it back. And I think everybody wants to bring that back. The only reason they put it there in the first place, remember, because it was a pay for. And they figured, well, we'll solve this within the next 5 years, and then COVID hit. That's what happened. So don't assume that just because, people want it, that we're going to get it, right? Nobody wanted to lose the research and development tax deduction, and yet we lost it. I think we're going to get it back. Now, what about other tax benefits, incentives that are out there? For example, oil and gas, not going away. Those incentives are there to stay. What about clean energy. Some of those are going to go away. Clearly, that's some of the pay for that they're looking at. They've talked about that as a pay for. They've really are looking at bringing a lot of those tax benefits back, and they're really big. I mean, the government's basically paying for 2/3 of your solar installation on your commercial building, right? And if you haven't done solar installation, you need to do it if it makes sense economically for you. Honestly, I put solar on my building, and the payback is so good because of the tax benefits. Without the tax benefits, won't be so good. So I would get going on that one. So let's talk about what are you going to do between now and the end of the year? Well, the first thing is, please, please, please call your congressperson. Call the person that is your representative in the House, particularly. I would worry less about the Senate. The Senate, they're gonna vote as a block, and they've got some pull because they do only have 53 Republican senators. But remember, the Republicans have a very slim majority in the House. So every single person, member of Congress, has a lot of clout. A lot of clout. Very much like Senators Manchin and Sinema did in the last administration on the Senate side, because they only had 50 Democratic senators, right? Kamala Harris was the tiebreaker in the Inflation Reduction Act. So what we have to pay attention to is we've got an opportunity here that we may never have again. And that is to there's a lot of talk about making the 2017 Tax Act permanent. Well, if you're going to make it permanent, you want to make sure that the qualified business income deduction is part of that permanent change, because that is the biggest issue. It'd be nice to get some changes to it because there are some limitations on it that really need to be modified. And so, but my point is, write to your congressperson because they will have an impact on this. And particularly if your congressperson is a Republican, and particularly if they're a Republican, write to them, because let them know that, hey, you're concerned about this qualified business income deduction. You're concerned about small business. They will listen to you. So that's number one. I don't get in politics a lot, but this time I think we need to. Second of all, what happens? Okay, so what do we do from a tax planning standpoint? Well, we have an opportunity here, because no matter what happens, okay, so qualified business income deduction, okay, all we can do there is talk to our congressperson, except don't have a Schedule C, okay? Just so you know, you lose your qualified business income deduction on a Schedule C. So you really want to be an S corporation or a partnership or a C corporation for tax purposes. Okay, you do not want to be a Schedule C sole proprietor. If you are, you're losing that benefit. You're paying Social Security tax on 100% of your income. There's just, and you're much higher chance of being audited. So why would you do that? So that's one change you can make. Okay, talk to your tax advisor about that. Now, what else can you do? Right? Because some of these things, they're just going to be what they are. Well, remember, how you make your money is really what Congress is going to be talking about in large part during this tax law change, which probably, by the way, won't happen until the end of the year. Remember, there's two big priorities of the Trump administration. The first is immigration. That's probably going to happen in 100 days. The second is taxes. Probably not going to happen until the end of the year. So you've got a whole year, you're going, okay, I don't know how my income that I receive is going to be taxed. Are my tax rates going to be higher because I lose the qualified business income deduction? Am I going to lose deductions for, if I buy real estate? Am I going to not have the same bonus depreciation? Maybe, but remember this, long before we had bonus depreciation. So this goes to number two, right? Number one is, so by the way, let's talk about rules. Rule number one is, it's your money, not the government's. So you have the opportunity to plan, and you have the right to plan. your tax liability, right? How much you pay in taxes is very much should be your choice based on what actions you take. As I always say, if you want to change your tax, you have to change your facts. And if you're willing to change your facts, you're willing to understand what facts to change, sitting down with your tax advisor, well, wait a minute, if I'm not a Schedule C and I'm an S corporation, how does that change my tax? That's a good example of that, right? So how you earn your money is the first question that you ask. How am I earning my money? And second of all is, what are you going to do with your money? So when you think about what you're going to do with your money, a lot of those tax benefits are not going to change. We're going to get the oil and tax benefits of intangible drilling costs. We're going to still have agricultural tax benefits. We're going to still have business tax benefits. We're going to still have real estate tax benefits. Remember, prior to the 2017 law, real estate was still the best tax shelter around, even though we didn't have bonus depreciation. So don't think that just because you don't have bonus depreciation, you still do a cost segregation. You're still going to take accelerated depreciation. It's just not going to be bonus depreciation potentially. Now this year, my guess is if they don't reinstate full bonus depreciation, they will probably just let it phase out, which means you got 40% this year. So keep that in mind. A lot of these tax benefits in 179, not changing. You're not going to lose that 179 deduction. So you want to buy equipment, you want to buy an SUV or a pickup truck that meets the 6,000 pound test. You want to pay your kids, use your tax brackets that you have available to you, not just your tax bracket, but those of your children. Remember, everything I talk about in tax-free wealth, that stuff's not going to change much, right? With the exception of the few things that we've been talking about. So what I would suggest is sit down with your tax advisor and look at 3 questions. First is, how do I make my money? Can I make my money in such a way? Can I change the way I report my income, Schedule C versus an S corporation, so that I pay less tax, regardless of what happens in Congress? Second, what am I doing with my money? Remember, if you save your money or spend your money, you get taxed on your money. That's not going to change. Savers are still going to get taxed. So, okay, so what are you going to do with your money? Well, you're going to come up with a wealth strategy to actually develop a plan of action so that you can invest your money in those things that the government encourages, such as business, real estate, research and development, energy, and agriculture. Okay, those are the big 5. So but you want to make sure that don't ever, by the way, please don't ever let the tax tail wag the investment dog. So don't do something for tax reasons. Don't go buy a big SUV because you get a tax deduction. You're still paying at least 60% of the cost, right? It's just a discount. The government's just giving you a discount on the investment. So don't do it for tax reasons, but include the tax benefits when you calculate your rate of return. Make sure you include that because now you have less invested. So for example, take my solar example. If I have $100,000 of solar, but I only put in $40,000, my return on it, because the government put in $60,000, my return on investment is based on the $40,000 I put in. So if my return is 7% a year, right? Make it easier. Let's say my return is 10% a year, right? On $100,000. Well, what is it on $40,000, right? It's 25% or something close to 25%, right? It's no longer 10% because I only put in 40,000 in the first place because of the government. So you want to consider that. The third question though is, what are you going to do with your money when you die? Here's something else that's unlikely to change. There has been talk about eliminating charitable deductions. I don't see it happening. I think the public policy of maintaining the charitable deduction is still there. So for example, let's say that your Bitcoin has gone way up in value. Well, maybe donate Bitcoin instead of donating cash to your favorite charity. Consider that. Now, don't donate just to get the tax benefit. All right. Donate because you want to donate. But why not donate the Bitcoin instead of cash? Pick up the same tax deduction, but not pay tax on the capital gains. Way better than donating cash. So what do you want to do with your money when you die? Probably for a lot of entrepreneurs includes charitable purposes. So there are things that you can do during the year. Now, I don't think we're going to have to worry about the estate tax exclusion. I do not think that's going to change much. I think they'll probably leave that where it is. There's not much money there, so it's not a big pay for. So I expect that will stay where it is and will not change, and they may make it permanent, which actually would be kind of nice for entrepreneurs. So with that, what are you going to do between now and April, besides file tax returns? You're going to send a note, call your representative in Congress, tell them we need that qualified business income deduction. Now, I will tell you, if it was up to me, we would not have a qualified business income deduction. We would have a deduction for dividends paid. If we had a deduction for dividends paid, we wouldn't need a qualified income deduction, right? Because we'd all be using the 21% tax rate. We'd all be C corporations, and then we just get a deduction for our dividends, the money we took out. That would make more sense. So we're still only being taxed once. What doesn't make sense is that we're taxed twice on dividends, right? Taxed once at the corporate level, once when we receive it. That's why we have pass-through entities. You'd eliminate a lot of the issues if we could just get a dividend deduction, right, for dividends paid. That's unlikely to happen. There's not been any talk of that I know of. So let's focus on that qualified business income deduction. The bonus depreciation, that's another one would be really nice to see. And the research and development expensing. Those are, to me, the three big ones for entrepreneurs. Those are the ones I would be talking to my congressperson about. And then plan now, plan early, plan often. That's the way I would say it. And when you do that, remember your taxes you're always going to make way more money and pay way less tax.
This podcast is a presentation of Rich Dad Media Network.